The financial media is obsessed with the price of silver. They are staring at the ticker tape, hypnotized by the fact that silver has broken $76 and is marching toward a 100. They are talking about supply deficits. They are talking about solar panels. They are talking about the mining crisis. And while all of that is true, they are missing the forest for the trees. They are looking at the fuse and ignoring the bomb. What is happening in the silver market right now is not just a commodity squeeze. It is a kinetic trigger event for the largest, most opaque, and most dangerous bubble in human history, the global derivatives market. The $30 billion in losses that 5 major U.S. banks are currently suffering on their silver shorts is a lot of money. But in the grand scheme of global finance, $30 billion is a rounding error. It's a bad quarter. It's a slap on the wrist. So why are the CEOs of these banks holding emergency meetings at 3 a.m.? Why is the Federal Reserve opening emergency swap lines? Why is the repo market freezing up? Because that $30 billion loss isn't isolated. It is the first domino in a chain reaction that threatens an $8 trillion notional derivatives complex held by U.S. commercial banks. To understand why, you have to understand the architecture of modern banking. Banks don't just lend money anymore. That's the old business model. Today, the real money is in trading risk. They write contracts, bets, essentially, on interest rates, on foreign currency exchange, on stock volatility, and on commodities. These are called derivatives. According to the Office of the Comptroller of the Currency, OCC, just 4 U.S. banks hold nearly 90% of the total derivatives exposure in the United States. These positions are leveraged, they are complex, and most importantly, they are interconnected. The silver short position that is currently blowing up was not a standalone bet. It was a hedge, it was collateral, it was part of a complex algorithm designed to balance risk across thousands of other positions. When silver moves 1% or 2%, the algorithm works. It adjusts, it rebalances. But when silver moves 150% in a matter of months, when it goes vertical, the algorithm breaks. The hedge becomes a black hole, and suddenly the collateral that was supposed to secure trillions of dollars in other bets, bets on treasuries, bets on the euro, bets on the S&P 500, that collateral is gone. This is the margin call moment. In the financial world, leverage is a double-edged sword. If you're leveraged 100 to 1, a 1% move against you wipes out 100% of your equity. The banks shorting silver were leveraged. They were betting with money they didn't have, assuming a low volatility environment that no longer exists. Now, let's look at the sheer scale of this. The notional value of derivatives held by U.S. banks is estimated at over $192 trillion globally, with a significant concentration in the top U.S. banks. The gross credit exposure, the amount at risk if counterparties default, is roughly $3 to $4 trillion in a normal market. But this is not a normal market. In a crisis, correlations go to 1. That means assets that usually move in opposite directions suddenly all move down together. When a bank takes a $30 billion hit on silver, they don't just write a check and move on. Their risk models, value at risk, or VAR, start flashing red. Their internal compliance rules force them to raise cash immediately to plug the hole in their balance sheet. Where do they get the cash? They can't sell the silver positions. They are trapped in a squeeze, so they have to sell what they can sell. They sell treasury bonds. They sell blue chip stocks. They sell corporate debt. This is how a crisis in a relatively small market like silver spreads like a virus into the deepest, most liquid markets in the world. We saw a preview of this in March 2020. We saw a preview of this in September 2019 during the repo crisis. But those were tremors. This is the earthquake. The silver market is the weak link in the chain because it is a physical market. You can print paper dollars. You can print digital stock certificates. You cannot print silver. Because silver is physically finite, the squeeze cannot be resolved by the Federal Reserve pressing a button. This means the losses for these banks are theoretically infinite. As silver goes to $80, $90, and $100, the hole in the balance sheet grows exponentially. And as that hole grows, the bank's credit rating comes under suspicion. This brings us to the most terrifying phrase in finance: counterparty risk. The entire derivatives market is built on trust. Bank A trades with Bank B, who trades with Bank C. They all owe each other billions of dollars at any given millisecond. They accept each other's promises because they assume everyone is solvent. But what happens when Bank A is bleeding $500 million a day on silver? Suddenly, Bank B gets nervous. Bank B stops accepting Bank A's collateral. Bank B demands cash up front. This is a run on the bank, but it's not happening at the teller window with grandma withdrawing her savings. It's happening in the repo market, in the dark pools, in the interbank lending systems. When trust evaporates in the interbank market, liquidity vanishes. It happens instantly. 1 minute, credit is flowing. The next, the window is slammed shut. This is what happened to Lehman Brothers in 2008. It wasn't just that they made bad bets on subprime mortgages. It was that everyone else on Wall Street stopped trading with them because they didn't know how deep the hole was. Silver is the new subprime. But it's worse. Subprime mortgages were a debt instrument. They could be renegotiated, they could be bailed out. Silver is a raw material. It is an industrial necessity. The demand is driven by physics, not finance. The banks are fighting the periodic table of elements, and they are losing. The regulators know this. The Federal Reserve knows this. Why do you think the Basel III requirements were relaxed? Why do you think the supplementary leverage ratio rules are constantly tweaked? They are trying to keep the game going. They are trying to prevent the mathematical inevitability of a derivatives implosion. But mathematics is stubborn. The leverage in the system requires calm markets to survive. It requires volatility to stay within historical norms. Silver just broke historical norms. It shattered them. The volatility we are seeing in precious metals is a statistical impossibility according to the risk models these banks use. This means their models are broken. They are flying blind. They don't know their actual exposure anymore because the formulas they use to calculate risk are based on a world that ended in December 2025. You might be asking, why does this affect me? I don't own derivatives. I don't short silver. You are asking the wrong question. You live in an economy that runs on credit. Every credit card swipe, every mortgage approval, every car loan, every payroll check depends on the plumbing of the financial system working. That plumbing is the derivatives market. It determines the interest rates you pay. It determines the value of the currency in your pocket. It determines the solvency of your pension fund. If the derivatives market breaks, the flow of credit stops. The ATMs stop working. The supply chains freeze because letters of credit aren't being honored. The $8 trillion figure I mentioned earlier, that's just the recognized exposure. The shadow banking system, hedge funds, family offices, private equity, holds trillions more in derivatives that are off the books, unregulated and unmeasured. These shadow entities are the ones often taking the other side of the bank's trades. When the banks get squeezed on silver, they start calling in loans to these shadow banks. Pay up or we liquidate you. This triggers forced selling across the entire globe. We are talking about a liquidation event that affects every asset class. Stocks, bonds, real estate, crypto. Everything gets sold to pay for the sins of the silver short. This is the contagion. It starts with a few $1 billion in a niche metal market. It ends with a systemic seizure of the global financial architecture. The fuse is lit, the spark is traveling down the line, and the bomb at the end of that line is the collective leverage of the entire Western banking system. They told you silver was a pet rock. They told you it was a barbarous relic. They lied. They knew that silver was the keystone holding up the arch of paper suppression. And now that the keystone has been pulled out by physical demand, the arch is crumbling. The $30 billion loss is just the entry fee. The real cost is going to be the collapse of faith in the paper promises that Wall Street has been selling for 50 years. The derivatives market is nothing but a mountain of paper promises. And in a world of physical scarcity, paper promises are worth exactly zero. Let's walk through the mechanics of the crash. We need to understand the anatomy of a liquidation cascade because this is exactly what is happening behind the closed doors of trading desks in New York, London, and Chicago right now. This isn't theoretical economics. This is the plumbing of the slaughterhouse. Imagine a trader at one of these major banks. Let's call it Bank X. Bank X is one of the big five, holding a massive short position in silver. For years, this trader's job was easy. Sell paper contracts, push the price down, trigger stop losses on retail investors, and buy back cheaper. It was a money printing machine. But now the machine is running in reverse. The price of silver is $76. The trader is underwater. His screen is flashing red warnings. The margin maintenance requirement, the amount of cash the bank must keep on deposit to keep the trade open, is skyrocketing. The exchange, the COMEX, sees the volatility. To protect itself, the exchange raises margin requirements. They tell Bank X, you need to deposit another $2 billion by $4 p.m. or we liquidate your position. This is a margin call. Bank X doesn't have $2 billion in idle cash sitting in a checking account. Banks don't keep cash, they invest it. They are fully invested. To get that $2 billion by $4 p.m., they have to sell something. They can't sell the silver, they are short. They have to sell assets that are liquid, things that can be sold instantly in huge volume without crashing the price immediately. What are the most liquid assets in the world? U.S. Treasury bonds, stocks like Apple, Microsoft, Nvidia, Amazon, the S&P 500 futures. So the trader hits the sell button, not on silver, but on the S&P 500. He sells $2 billion worth of stocks to raise the cash to cover the silver loss. Now, multiply this by 5 banks. Multiply it by the dozens of hedge funds caught in the same trade. They are all selling the S&P 500 at the same time. Suddenly, the stock market drops 3% in 10 minutes. The financial news anchors are confused. Why is the stock market crashing? They ask. Earnings were good. The economy is fine. They don't understand that the stock market is being used as an ATM to pay for the silver crisis. This is called cross-asset contagion. But it gets worse. Modern markets are run by algorithms, trading bots. These bots don't care about fundamentals. They care about price action and volatility. When the bots see the S&P 500 drop 3% rapidly, their risk parameters trigger. They interpret this as a crash signal. So the bots start selling too. They sell more stocks. They sell oil. They sell Bitcoin. They sell everything to move to cash. This creates a feedback loop. The bank selling caused the drop. The drop triggered the bots. The bots selling causes a bigger drop. Now, let's look at the risk parity funds. These are massive funds, trillions of dollars, that automatically balance their portfolios based on volatility. When volatility spikes, which happens when banks panic sell, these funds are mathematically forced to sell assets to reduce risk. They become indiscriminate sellers. This is how a $30 billion loss in silver transforms into a $3 trillion loss in global equity markets. It's the butterfly effect, weaponized by leverage and algorithmic trading. The silver squeeze is the pebble that starts the landslide. And we haven't even talked about the bond market. This is where the real danger lies. U.S. Treasury bonds are the collateral for the entire financial system. They are supposed to be risk-free. But when banks are desperate for cash to cover silver losses, they dump treasuries. When you dump treasuries, the price of the bond falls and the yield interest rate rises. Suddenly, interest rates spike. Not because the Fed raised rates, but because the banks are liquidating their reserves. Spiking interest rates are kryptonite to the economy. Mortgage rates jump. Corporate borrowing costs explode. The housing market freezes. All because 5 banks got caught shorting a metal that is needed for solar panels. This mechanism is brutal because it is indiscriminate. It punishes prudent investors. You could be holding a perfectly good stock, a company with great profits and no debt. But if Bank X owns that stock and Bank X needs cash to pay for its silver mistake, your stock is going down. The market doesn't care about value, it cares about liquidity. In 2008, gold and silver initially crashed alongside stocks. Why? Because people sold what they could, not what they wanted to. They sold their gold to pay for their margin calls on real estate. We might see brief volatility in silver during the initial panic, a momentary dip as some players are forced to liquidate profitable long positions to cover losses elsewhere. But here is the critical difference between 2008 and 2026. In 2008, there was no physical shortage of gold or silver. Today, there is. So even if paper speculators try to sell silver to raise cash, industrial buyers, Tesla, Samsung, the Chinese government, are sitting there with open arms, ready to vacuum up every physical ounce that hits the market. The dip will be bought instantly. The floor is solid concrete. The liquidation machine is running out of fuel. The banks are running out of assets to sell. We are approaching the VAR shock moment. Value at risk. VAR is a metric banks use to calculate the maximum they can lose in a day. When markets move more than the model predicts, the bank is legally required to reduce its size. To reduce size, they have to close positions. This means buying back the silver shorts. But who will sell to them? The miners aren't selling. They are holding out for higher prices. The investors aren't selling. They smell blood. The Chinese aren't selling. They need the metal. So the bank has to bid the price up. $80, $90, $150, and every tick higher forces them to sell more stocks, more bonds, more real estate assets to fund the buyback. It is a death spiral, a self-reinforcing loop of destruction that eats the bank's capital from the inside out. The media will call it a flash crash. They will blame glitches. They will blame Russian hackers. But you will know the truth. You will know that the equity markets are crashing because the silver market is repricing reality. This is the moment where the paper wealth of the last 40 years evaporates. All the gains in the stock market that were driven by cheap credit and leverage, they are being clawed back by the laws of physics. The liquidation machine destroys the illusion of wealth. It reveals that you cannot have infinite financial assets on a planet with finite physical resources. When the claims on resources, dollars, derivatives, exceed the resources themselves, silver, gold, or oil, the value of the claims must collapse. We are watching the great leveling. The banks are desperate to keep the game going for one more day, one more week. They are using high-frequency trading to try and confuse the market. They are using dark pools to try and hide their selling, but they cannot hide the hole in the vault. When the COMEX reports that inventory has dropped another 5 million ounces, the algorithms read that data, and even the algorithms know that zero means zero. The AI that runs Wall Street is starting to realize that the humans who programmed it failed to account for physical scarcity. So the machines will switch sides. The same algorithms that suppressed silver for decades will suddenly turn long. They will front-run the banks. They will buy the breakout. And when the machines turn on their creators, the liquidation won't just be severe, it will be total. This is not a correction. This is a transfer of assets. The wealth is moving from those who hold paper to those who hold metal. The liquidation of the paper market is the necessary precondition for the liberation of the physical price. Wall Street is currently burning the furniture to heat the house. They are selling the crown jewels of American industry, tech stocks, bonds, blue chips, just to keep their short silver positions alive for another 24 hours. It is madness, it is suicide, and it is happening right now. Now we enter the darkest room in the financial haunted house. We need to talk about the daisy chain. This is the part of the crisis that transforms a market crash into a civilizational event. This is about the breakdown of the legal and trust-based infrastructure of the global economy. In the world of high finance, nobody actually pays for anything with real money up front. It's all credit. It's all IOUs. Bank A enters a derivatives contract with Bank B. They agree to settle the difference later. They post collateral to each other, usually U.S. Treasury bonds, to prove they are good for the money. But here's the dirty secret they don't teach in Economics 101, rehypothecation. Rehypothecation is a fancy word for legal fraud. It means that when Bank A posts collateral to Bank B doesn't just put that collateral in a safe. Bank B takes that collateral and uses it to open their own trade with Bank C. And Bank C takes that same collateral and trades with Bank D. The same U.S. Treasury bond might be securing 5, 10, maybe 20 different trades simultaneously. It's a game of musical chairs where 20 people are circling one chair. As long as the music plays, everyone lists that chair as an asset on their balance sheet. Everyone feels rich. But the silver squeeze just stopped the music. When Bank A blows up because of its silver shorts, when it becomes insolvent, Bank B suddenly realizes that the collateral it was holding from Bank A is gone. It has been liquidated or frozen in bankruptcy court. But Bank B needed that collateral to secure its trade with Bank C. Now Bank B is in default. Bank C is in default. The entire chain snaps. This is systemic counterparty failure. It turns out that nobody actually has the assets they claim to have. They only have claims on assets that someone else has claims on. When the base asset, the silver or the cash to cover the silver, isn't there, the web of claims dissolves. This leads to a credit freeze. We saw this in 2008, but this time it will be absolute. Banks will stop lending to each other overnight. Why would you lend $1 billion to JP Morgan or Citibank overnight if you suspect they might be insolvent by morning because of their silver exposure? You wouldn't. You would hoard your cash. When interbank lending stops, the world stops. Letters of credit for shipping containers are rejected. Cargo ships drop anchor in the middle of the ocean because the exporters can't trust the banks to pay them. Payroll processors can't access short-term funding lines, so paychecks bounce. This is the real-world consequence of a derivatives collapse. And who is supposed to fix this? The clearinghouses, the CME Group, the OCC. These are the central entities that stand between buyers and sellers to guarantee trades. They have guarantee funds, pools of money contributed by member banks to cover defaults. But look at the math. The guarantee funds are in the billions. The derivatives exposure is in the trillions. If one major bank fails, the fund might survive. If two fail, the clearinghouse itself becomes insolvent. If the clearinghouse fails, every futures contract in the world, not just silver, but corn, oil, interest rates, currency, becomes legally void. The exchange closes. The screens go black. You're left holding a piece of paper that says you have a contract, but there is no entity left to enforce it. This is the force majeure scenario. Force majeure is a legal clause that frees parties from liability due to unforeseeable circumstances. You can bet your life that the banks will declare the silver squeeze an unforeseeable act of God, rather than admitting it was the result of their own criminal negligence. They will try to settle contracts in cash. They will say, "We can't give you the silver, and the exchange is broken, so here's a check for the closing price on the last trading day." But what is that check worth? If the clearinghouse is broken and the banks are failing, the check is just paper. And if you take that check to buy physical silver in the street market, you'll find that the price is triple what the bank paid you. You have been robbed in broad daylight legally. This is the trap of the paper market. It works until it doesn't. It is a system designed to extract fees from investors during good times and default on obligations during bad times. We must also look at the shadow derivatives. These are the over-the-counter OTC swaps. These trades don't happen on an exchange. They are private contracts between banks and hedge funds. There's no transparency. No regulator sees them until they blow up. The $30 billion silver loss we know about is just the exchange-traded loss. The OTC loss could be 5 times that amount. We know that many tech companies and industrial giants hedge their silver needs via OTC swaps. If the banks on the other side of those swaps fail, these industrial companies lose their price protection. Their costs skyrocket instantly. This leads to corporate bankruptcies. A solar panel manufacturer that thought it had locked in silver at $30 for the next 5 years suddenly finds out its hedge is worthless because the bank counterparty is gone. Now they have to buy silver at $100 on the spot market. They can't. They go bust. The counterparty contagion spreads from banks to the real economy. It destroys supply chains. It shuts down factories. It creates mass unemployment, all because the financial sector was allowed to turn the global commodities market into a casino. The legal teams at these banks are already preparing. They are drafting the notices. They are lobbying Washington for a bail-in. What is a bail-in? In 2010, the Dodd-Frank Act was passed. It ended bailouts, taxpayer money given to banks. Instead, it codified bail-ins. A bail-in means the bank saves itself by seizing the assets of its creditors and depositors. If you have a deposit at a bank, you are legally an unsecured creditor of that bank. If the bank fails due to a derivatives collapse, they can legally convert your savings into equity in the failing bank. You go to the ATM and your money is gone. Instead, you get shares of Bankrupt Bank Corp. This is not a conspiracy theory. This is the law. It has been used in Cyprus. It is in the terms and conditions of your account. The $8 trillion derivatives bomb is wired directly to your checking account. The fuse is silver, but the explosive charge is your savings. The counterparty risk is not just between banks. It is between the bank and you. You are a counterparty to your bank. When they lose on silver, you lose. This is why the rush to physical assets is accelerating. Physical gold and silver have no counterparty risk. If you hold a silver coin in your hand, you don't need a bank to remain solvent for that coin to have value. You don't need a clearinghouse to function. You don't need a legal contract to be honored. It is wealth in isolation. The system knows this. That is why they hate gold and silver. That is why they have suppressed the price. Because independent wealth is a threat to a system built on interdependence and debt. But the daisy chain is snapping. The links are breaking. We are seeing the separation of solvency and liquidity. A bank might be solvent on paper, assets, liabilities, but liquidly dead, no cash to pay bills. And in a panic, liquidity is all that matters. The nightmare scenario is a gridlock, a situation where nobody pays anybody because nobody knows who's broke. The flow of money simply stops. The heart of the global economy goes into cardiac arrest. And standing over the patient, holding the defibrillator, is the Federal Reserve. But this time, the patient might not wake up because you can't shock a corpse back to life. And the mathematical reality of the derivatives market, with its infinite leverage and rehypothecated collateral, is legally and structurally dead. So how does this end? We have established the trigger, silver, the mechanism, liquidation, and the systemic failure, counterparty collapse. Now we must look at the response. What happens when the $8 trillion bomb actually detonates? We know the playbook. We have seen it before, but this time the scale is different. The Federal Reserve and the U.S. Treasury will panic. They will see the banking system imploding. They will see the ATMs freezing. They will see the stock market down 40% in a week. They will do the only thing they know how to do, print. But this won't be quantitative easing, QE, as we knew it. This will be hyper-liquidity. The Fed will have to print enough money to cover the hole in the derivatives market. But remember, the hole is theoretically infinite because the price of silver is unanchored. If they try to bail out the silver shorts, they are effectively agreeing to subsidize the price of silver for the entire world. They would have to print trillions of dollars to pay off the contract holders. When they announce this, and they will, likely on a Sunday night after a closed-door emergency session, the world will realize that the US dollar is being sacrificed to save the banks. This is the crack-up boom. The stock market might turn around and skyrocket in nominal terms. The Dow Jones might go to 100,000, but a loaf of bread will cost $50. And an ounce of silver? It won't be trading for dollars anymore. The divergence between the paper economy and the real economy will become absolute. The paper market for silver will likely be shut down. The COMEX will close. They will settle remaining contracts in worthless cash. A new market will emerge, a decentralized, physical-only market. Price discovery will happen on the street between individuals and between sovereign nations. The spot price you see on TV will be a museum exhibit, a relic of a dead system. The real price will be whatever amount of currency it takes to convince someone to part with their metal. This is the death of the current financial paradigm. The system built in 1971, when Nixon closed the gold window, was based on the idea that debt could expand forever without consequence. Silver just proved that false. Silver proved that eventually you need the goods. We will see the implementation of capital controls. The government will try to stop you from moving your money out of the failing banking system. They will limit withdrawals. They will try to ban the purchase of physical gold and silver, labeling it hoarding or economic sabotage. We are already hearing the rhetoric. They will say that speculators are hurting the green energy transition. They will try to seize metal for national security. This is why holding your metal outside the banking system is non-negotiable. If it is in a bank vault, it is not yours. It is theirs. The geopolitical consequences will be history-defining. The BRICS nations, Brazil, Russia, India, China, South Africa have been preparing for this. They have been accumulating physical gold and silver while the West accumulated paper derivatives. When the Western derivative system collapses, the East will stand up. They will offer a new monetary system backed by commodities, a basket of currencies backed by gold, silver, oil, and rare earth metals. The US dollar, stripped of its trust and diluted by hyperinflationary bailouts, will lose its status as the world reserve currency. It won't happen overnight, but the silver crisis will be the point of no return. The moment the world realized the emperor had no clothes and no silver, pension funds will be wiped out. The safe 60-40 portfolio of stocks and bonds will be incinerated by the twin fires of asset liquidation and inflation. An entire generation of middle-class wealth, stored in paper assets, will vanish. But wealth is never destroyed. It is only transferred. The wealth is moving to the hodlers, to the people who understood the difference between value and price, to the people who held physical reality while the world played with digital fantasies. This is the Great Reset, but not the one the globalists planned. This is a reset imposed by natural law. The complexity of the derivatives market created a fragility that could not withstand the stress of physical scarcity. The $8 trillion bomb cleans the slate. It wipes out the debt because the debt can never be paid. It wipes out the leverage. It forces humanity back to a baseline of reality. For the prepared, this is an opportunity. Silver at $76, $100, even $200 is cheap compared to what is coming. When the currency collapses, the value of silver becomes infinite in dollar terms because the denominator, the dollar, goes to zero. We are entering a period of chaos. Banks will fail. Governments will topple. Supply chains will fracture. But on the other side of this chaos is a more honest world. A world where you cannot print wealth. A world where a promise to pay is backed by something real. The fuse is burning short. The sparks are flying. The banks are sweating. The algorithm is glitching. You have a choice. You can stay in the burning building, hoping the firefighters, the Fed, can put out the fire with gasoline, money printing, or you can exit. You can secure your labor and your savings in the only asset class that has survived every currency collapse in 5,000 years of human history. Silver didn't cause this. Silver just exposed it. The bomb was built by greed. It was wired by hubris. And it was armed by apathy. But it is silver that triggered the countdown. Tick, tick, tick. The explosion is inevitable. The only variable left is your position when the shockwave hits. Are you holding paper, or are you holding the pin that popped the bubble? December 2025 was the warning. 2026 is the event. The $8 trillion bomb is detonating. And for the first time in history, the banks are on the wrong side of the trade, and there is no one left to bail them out who has pockets deep enough to fill the void.